Okay, video 2. Now we're going to look at the budgeting thing. We're going to look at a budgeted income statement, a budgeted retained earnings, and a budgeted balance sheet. So here we go. And these were plug and chugs in many cases. Sales, I gave it to you. It was a given out here at the side, remember? See? So we had sales of $1,485,000. Cost of goods sold was $27,000 times $30. You just had to multiply that. And then you subtracted to come up with a gross profit of $675,000. And then these were just pull-ins from over here. Now the trick was you had to add all of these to get the total overall for the quarter. So sales commission was $297. Salaries was $15,000, 5,000 times 3. General admin was $36,000, 12,000 times 3. Maintenance expense was $6,000, 3 times 2,000. Interest expense was $150. Depreciation expense, I gave it to you at $20,300. So that's all of our expenses. And all you had to do was add those up to get a total of $374,450. You would take that and subtract it from the 675 to come up with income before taxes. And then income tax is 40% of that. And that would give you an income tax of $120,220 and gives you a net income for $183,330. So what do you do with that now? So I've got this done. Now I'm going to use my retained earnings, because I need to do a balance sheet and I need to adjust my retained earnings. I started with $246, which I gave to you. I added the net income and I come up with a new retained earnings of $426,330. That gets plugged over here, right here in retained earnings. And then the rest of this, you just follow this additional information. This is the one that kicked everybody. What was the cash? The cash is the ending balance in the cash budget. Last column, last number, 143,400. That's the ending cash for that quarter. So that gets plugged in. Here we go. So we've got that. And then AR is in note C, which is right here. You want the ending balance on all of these. So 602,250. Your finished goods was 60,000 right here. And if you add those up, those are current. Those are $805,000. Our land came in at $150,000. I gave that to you. And then you had to calculate equipment and accumulated depreciation. So what was our ending equipment balance? $700,800. If you went down and you found the accumulated depreciation had increased to $80,800. So you net those two. You can hear my puppy in the background. If you net these two, you come up with $1,613,000 book value net for your equipment. And you add the 805, the 150, the 613, and come up with total assets of $1,568,650, which matches the check. So then you could proceed down with the accounts payable, which you will find on note G. The very ending is $549,600. There was no bank loan. You paid it off, remember, from the budget. You had taxes payable from the income statement of $120. You calculated that. And that gives you current liabilities, if you add those up, of $669,820. Your common stock was $477, I think. I gave that to you. This you figured out in the retained earnings. And that gives you total stockholders' equity, if you add those two together, of $898,830. And if you add that to your total liabilities, you come up with $1,568,650 for your budget. And that's how you use to project budgeted financial statements, which you could take to the bank then. Does that help? I hope so. Here we go.